Sorry, I just noticed the recording is not working, so I decided to find what happened. Okay, Mr. Daniel, your hand is up. Mr. Daniel. Mr. Daniel, your hand is up. Do you have a question? If you don't have a question, you can lower your hand. Let's continue. Okay, let's assume he's having network issues and let's continue. So, IFRS IFRS 1 says first time adoption of IFRS, that's the International Financial Reporting Standard. And the first time IFRS was adopted in Nigeria was in 2011. There was not a full adoption in 2011. The full adoption took place in 2012, where most companies, businesses, most especially commercial banks, started using IFRS. Now, there's what we call IFRS conversion. It's the services auditors render. It's a kind of an account that we prepare outside the audited account in way and manner as to convert the company's accounting information flow from GAAP to IFRS. So there's a lot of adjustments that will be done on the financial statements, and the auditor after the computations will issue out audit journals to reflect these financial flows in IFRS standards. So the audit journals will be passed so that the financial statements will still represent a true and fair view using IFRS. So that is for IFRS 1. Now, the reality is that at the level of IFRS, there will always be updates, just like every regular accounting line. Alright, so just like accounting, taxation, and other financial institutions, there will always be updates, there will always be improvements, and so on and so forth, because the financial nature of businesses and companies, as well as NGOs, are consistently improving. The world is evolving, and as the world is evolving, businesses are improving, businesses are getting more complex, and for that reason, IFRS will continue to update its standards or her standards, whichever way you want to see it, and will keep going from one level to another. So at every point in time, there will always be IFRS publications, either countering a standard or improving a standard or writing of a particular standard or replacing a standard with another standard. So outside this IFRS, we also have IAS. I think they are from 1 to 38 or 30 something. But this lecture is focused on IFRS, so we have just the IFRS on our slide. So the 19 of them are on our slide. Now, IFRS 2, we talked about share-based payments. Share-based payments. Share-based payments is about the payment you make to the owners of the company with respect to their shares. Alright, so probably the company has a retained earning of 300 million for the year 2024, and as at the AGM meeting of 30th June 2025, the company decided that out of the profit of 300 million, 100 million will be sent to retained earnings, 200 million will be shared amongst the shareholders. And probably amongst these shareholders, so the company may have agreed that the share the shares that their retained earnings out of the 300 million, they would release 200 million for their shareholders to be shared amongst them. Now, if we want to share this 200 million, we would have to split it according to what we call share-based payments. So you cannot expect somebody that owns 300 shares to get the same amount with somebody that owns 10,000 shares. It's not fair. So when we're paying dividend, we apply the system we call share-based payments. So you are sharing that dividend according to the volume of investment. So we do, if we have 1 million shares in the company and we are sharing 200 million naira, it means we'll do 200 million over 1 million, that is 200 naira per share. So each share has 200 naira. So the shareholders will be credited according to their volume of shares. So if you have 300 shares, 300 times 200 naira per share, that will give us 60,000. You'll be credited 60,000. If you have 10,000 shares, 10,000 times 200 naira is 2 million. So you'll be credited 2 million naira for your shares. So I think that is that for the share-based payments part. But we said we are not going deep into share-based payments in our last class, because this lecture we are treating a small company that is into trading. We are treating a small company that is into trading. So for that reason, we did not go depth in share-based payments. So we are looking at the third one, business combination. This business combination is where we spend almost a lot of time, because business combination has to do with 1, 2, 3, 4 companies that are under the same owner or under the same set of owners. Companies that are under the same owner and under the same set of owners. So now, when we are looking at companies that are under the same owner, or companies that are under the same set of owner, we are looking at parent company, subsidiary companies, joint ventures, and associates. Now, don't get me wrong, in a group account, you don't recognize companies that are not, we have joint ventures, we have associates, we have the ones we call investments. We don't recognize investments in a group account. When you're doing consolidation, you don't recognize investments. Let's say the shares of, I'll give you an example. Let's say Okechukwu and Co. We own Dare and Co. and we own it 100% ownership. And then Dare and Co. has a 40% share in Nyesom and Co., which means because it's not up to 51%, they are an associate. They are an associate, so they are not the major shareholder. So it means they are not the parent company. They are an associate. Now, let's assume that the same Okechukwu and Co. has 10% share capital of Kingsley and Co. Now you see that Kingsley and Co. is just a mere investment. It's just a mere investment. So these are things that we looked at, and we said in business combinations, the structural level in business combination, you have to find out if it's a mere investment, if it's a joint venture. A joint venture is like partnership, but not entirely partnership. Now, why is joint venture different? Joint venture is a situation where I own a business and maybe Mr. Daniel owns a business. Then two of us will say, okay, there is this particular contract I want to do and I can't do it alone. Then I will contact Mr. Daniel and say, let's two of us team up and do this contract. So our merger is temporal, and the reason we are merging is because of this contract. So if anything happens and the contract is no longer in existence, our merger ceases to exist. What do I mean by no longer in existence? If the contract fails, or maybe there is breach of contract amongst any of the parties, or maybe we have successfully completed the contract and collected our money, or maybe the person that contracted us have pulled out his money as well. Then if that is the case, the company, the contract relationship between the two of us ceases, because it's joint venture. That's the difference between joint venture and partnership. In joint venture, we are partnering for a particular purpose, and joint venture is mostly partnership between existing businesses. But in your regular partnership, single two people can partner and form a business, and existing businesses partnering to form a business will close down, like Okeke and Co and Chigozie and Co will close down Okeke and Co, close down Chigozie and Co, and they can now, two of them will now open Okechi and Sons. So Okeke and Co ceases to exist, Okechi and Sons ceases to exist, Chigozie and Sons ceases to exist. What starts existing is Okechi and Sons. So that's that for that. Now, we also discussed about the financial flow in business combination, and we said that when we are doing business combination, the financial trend is entirely the same for the individual companies. So when the parent company is preparing their accounts as a parent company, not the consolidated now, like just their regular parent company account, they will prepare it normal. They'll prepare it normal. Everything, including transaction with subsidiaries, they'll prepare it normal inside their own account. Now, the subsidiary too, when they are preparing their financial statements, they'll prepare it normal, exactly how they are meant to prepare it. When they finish it, it's going to be the way they prepare your regular financial statement, irrespective of what the transaction is. Now, where we have a problem is in consolidated financial statements. That's where we have a problem. And we said that in consolidated financial statements, we are looking at number one, accounting has 5 legs: assets, liabilities, equity, income, and expenditure. Now, let's start from the smallest one, the expenditure. Expenses that are intergroup related will be written off. Let me give you an example. Let's say I paid money to as chairman of Sunday and Co. I paid money to Kingsley and Co, which is a sister company. Now that expenses will have to be written up. Kingsley and Co, the income they received from us will have to be written up. Now, we also looked at the income part. So the income at Kingsley and Co will have to be written off. The expenses at Kingsley and Co will have to be written off. Then we also discussed about group related expenses, joint expenses. Let's assume the two companies are using the same building and they have joint costs. So maybe I will pay today as the accountant of the HQ. Maybe Daniel will now pay the next expenses as the accountant of the subsidiary, and like that we'll just be sharing it. In that scenario, we'll just open an intercompany account. When I pay, I'll record, Daniel will record that he's owing me his own share of the expenditure. Then when Daniel pays, he records, and then I will record that I'm owing Daniel my own share of his expenditure. At the end of the day, we will nail it off. We also looked at a scenario where the company refunds the other company for expenditures they made on their behalf. So we said something like, assuming the two companies agreed that their share cost will be 50-50%, then maybe I took I paid for electricity bill 100,000. Now, having paid the electricity bill of 100,000, I would debit electricity 100,000, debit intercompany 100,000, and credit bank 100,000. Sorry, I paid electricity 100,000, so I'm going to debit electricity 50k, debit intercompany 50k, and credit bank 100,000. So it's going to be 50-50 and 100, because what left my bank account was 100,000, but my share of the expenses is 50k. So 50k goes to expenses account and 50k goes to intercompany, because Daniel is owing me 50k. So that's for the intercompany account. Then we also discussed about the consolidation. We said that on the consolidation proper, that's when we're looking at the balance sheet items. 4 things will give you problem in the balance sheet items. 4 things. And the 4 of them are: number one, under assets, goodwill. Goodwill will, goodwill will always be a problem, because valuation of goodwill depends on a whole number of factors. Now, factors like purchasing cost, net asset cost, and other obscure factors are part of goodwill. So if you try computing goodwill while you are preparing the consolidated inside the account, you will mess up the account. Another thing that will give you a headache is inventory. Inventory is always a headache. The PPE remains the same, so you just add all the PPE together. So we have goodwill, we have inventory, we have retained earnings. So you remove goodwill, remove inventory, remove retained earnings, remove investment in subsidiary. When you come to the asset account, you remove investment to subsidiary, you remove loan to subsidiary. Now, when we remove these things, why we will remove them is because we have to adjust for them properly before we put them into the account. For your PPE, number one thing in PPE is finding out all the assets wherever they are. In the last class, somebody asked a question about maybe the headquarters bought 50 cars and they have branches all across Nigeria, and they started sending one car each to all the states. And then states that have more than one branch, they will send 2 cars to that state, one for each branch. Then head office has some cars, and so on and so forth. And I told them, yes, in that scenario, each car is going to will have car papers. So the documentation for that car will be a transfer letter accompanying that asset. That car now, there will be a transfer letter stating that the head office bought this particular asset, 50 pieces in number, and they shared it to the whole 36 states. And this particular car with plate number so, serial number so is being sent to Enugu State to be in the transfer letter. Then a photocopy of the receipt showing the 50 cars bought, the unit price, and so on and so forth. A photocopy of the invoice that came with the 50 cars when they came together. will be attached to the car papers. These three documents will be sent there, so that whoever is asking about that asset, be you auditor, be you be you tax person, nobody will have a problem with that documentation. Then we also discussed about the financial representations on the balance sheet, and I said that we have to remove these four items. Now when we remove it, after the PPE documentation, we will come to the retained earnings. The retained earnings will have adjustments when we have non-controlling interests. If we don't have non-controlling interest, then we don't have a problem. But if we have non-controlling interest, we have to adjust for the non-controlling interest. So why do we have non-controlling interest? Non-controlling interest can only arise if the parent company does not own 100% of the shares of the subsidiary. If the parent company does not own 100% of the shares of the subsidiary, then there is need to prepare adjustments for the non-controlling interest. In the same vein, we are looking at a scenario where we adjust for inventory. Now, why do we need to adjust for inventory? Adjusting for inventory calls for what we call goods in transit. In goods in transit situation, we have a scenario where maybe I can give you a direct example with something that we are all familiar with. In Enugu, we have Nigerian breweries in Enugu, but there is beer in Lagos. People take beer in Lagos. People take beer in Ilorin. People take beer all across Nigeria. But the only place beer is produced in Nigerian breweries is the one in Enugu State. Now let's assume that those distributors are different branches of Nigerian breweries, because there are companies like that. But let's assume that those different distributors are branches of Nigerian breweries. Now, Enugu produced on 30th June or 31st January 2025, and because Enugu has produced, some people are trying to get into this class and they are distracting me, and I've sent link to the group chat. This one says he sent to his email. Okay, let's continue. Now, in that scenario, the drinks will leave Enugu. The drinks will leave Enugu that 30th January or 30th June. It will leave Enugu and start going to Ama breweries. Now when the drinks is going to Ama